Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So I'm sure by this point you all know who Ben Graham is, the author of The Intelligent Investor. Ben Graham is the Dean of Value Investing. He sort of founded all this value investing stuff. He was Warren Buffett's teacher, and many of his core concepts from this book still hold true today. We have the core concept of a margin of safety really driving your investments sort of process as a value investor, trying to buy something for less than it's fundamentally worth. We know that a stock is a real piece of ownership in a business and sort of should be treated as such. And we know that Mr. Market is there to serve us rather than instruct us. Now, these are all core concepts that Ben Graham talks about in The Intelligent Investor and really are just as true today as they were 80, 90 years ago when Ben Graham was running his own investment partnership. But there are a few areas where, in the opinion of a lot of more modern value investors, even people like Charlie Munger and Warren Buffett, there's a lot of areas where they think Ben Graham went wrong and could have sort of improved upon his process. So in this video, I'm going to talk about a few of the things that Charlie Munger in particular has mentioned in the past about where he thinks Ben Graham potentially went wrong and could have done better than he did. And keep in mind that Ben Graham returned about 20% a year, so doing better than 20% a year over the lifetime of his investment partnership would be pretty incredible. But these are nonetheless some of the things that Charlie Munger in particular had to say about Ben Graham's investing process and where he thinks that improvements could certainly have been made. Now, by far and away the most famous change that Buffett and Munger have made from the original value investing philosophy sort of supplied by Ben Graham is to transition from this sort of cigar butt style of investing through to buying higher quality businesses at slightly higher prices if you were to look at them on things like PE ratios or price to book ratios or something like that, but still trying to understand that those higher quality businesses can be equally as undervalued as a cigar butt, if not even more undervalued, if you take into account the future growth and high returns on capital and so on that these really high quality businesses can generate. Now, cigar butt investing, for those that don't know, is really what Ben Graham specialized in, and it's actually how particularly Buffett, but even Munger sort of started out their careers as well in the investment business. And cigar butt investing is basically the process of looking at a particular company and really not caring at all about the quality of the business. The business may in fact be losing a lot of money for all we know. Really, it was sort of like a balance sheet style of investing. It was looking at the assets of the company versus the liabilities of the company versus the price of the business. And basically what Ben Graham and the early sort of Warren Buffett was looking for was he was trying to find businesses where you could basically go in and just liquidate the company and make a profit. That's how cheap that these businesses were trading. Really, there was no value at all being put on sort of the earnings engine of the company. You could go in, basically close down the business, sell off all their assets, even at sort of fire sale prices, and still make a profit from going through that process. And that worked really, really well for a long period of time. And although those opportunities are a little bit more kind of few and far between in today's sort of market, they do still exist, and there are still small investors that go out and do this more active style of investing and can generate good returns from cigar butt, investments as well. But one of the main issues with cigar butt investing, particularly for Buffett and Munger as they kind of became more and more and more successful over time, is that this isn't really a strategy that scales well. So when you're managing billions of dollars like Buffett and Munger were sort of starting to get into when they were going through sort of the 70s, 80s, 90s, really that strategy just didn't scale up to those large sums of money. There weren't multi-billion dollar acquisitions they could make of cigar butt companies. Usually these were small little weird companies that were kind of underfollowed, very small market caps, very thinly traded. And these things just flat out didn't exist when you were starting to talk about making, hundreds of millions or billion-dollar acquisitions like Berkshire Hathaway were starting to do. So Buffett and Munger were in a way sort of forced towards this style of investing in higher quality businesses. And this is what Charlie Munger had to say about it in sort of a speech that he gave once. So he said, "We realized that some companies selling at 2 or 3 times book value could still be a hell of a bargain because of the momentum's implicit in its position. Sometimes once combined with an unusual managerial skill, plainly present in some individual or other, or some system or other. If a business earns 18% on capital over 20 or 30 years, even if you pay an expensive looking price, you'll end up with one hell of a result. Now, the second big mistake, and arguably one that is potentially even larger than the first one, just depending on how you look at it, is basically that Ben Graham was often trying to predict the outcome of the entire stock market. He wasn't necessarily always focused on individual businesses in his writings, which is kind of unusual. And I was actually surprised when I first read The Intelligent Investor how much sort of macro kind of overall stock market stuff was actually in that book. When you look at Ben Graham's actual investment strategy, really he was pretty much always buying into individual companies. He really wasn't focused on the overall market at all, although he did talk about sort of more passive investing strategies where you just buy a basket of businesses and so on. Wasn't really something that he did in his own investment partnership. And Charlie Munger actually said in a speech, and I'll try and put an exact sort of screenshot up here somewhere, something along the lines of, Ben Graham, the great man he was, had a bit of a screw loose in trying to predict the outcome of the overall stock market. And effectively what Munger was saying here is that if you find an attractive business at an attractive price, but the overall stock market seems to be really high in general, it shouldn't matter. You should still go ahead and buy that high quality business at an attractive price. Munger talks about this, Buffett talks about this, Munger talks about this all the time. And even when we get to sort of extremes in markets, we've got some actually reasonable evidence that still buying good businesses at attractive prices, even when overall markets might be elevated, can still be, a really good thing for your returns. If you had set out in, say, 1999, 2000, because you thought that the market was just really high, if you just got out altogether, you would have actually missed out on one of the greatest, short kind of periods of returns for the lower PE, lower price to book, typical value stocks. Although that isn't how I invest personally, the more quantitative people do tend to do that. You would have missed out on one of the strongest performing periods for those stocks from about 2000 to 2005 kind of period. So even when markets are elevated, if you can buy good businesses at attractive prices, you can still come out the other end really, really well. And I don't think that you should be influenced necessarily by what the overall stock market is doing, because you're not buying the overall stock market. You're someone that's focused on individual businesses. If you find a phenomenal company that's going to earn, say, $10 million a year indefinitely, it's almost guaranteed. Maybe it's a railroad business and they just, it's going to be very, very difficult to disrupt that company. If you can buy that business for like 3 times earnings or something, who cares what the stock market as a whole is going to do? You're going to get your money back in 3 years. So if you find something incredibly attractive, even though the overall market is really high, that is probably something that you should still make the investment in. And I believe it was Jake Taylor over at the sort of Value After Hours podcast that described focusing on macro kind of whole stock market, worldwide economy type stuff as kind of like eating dessert. Maybe if you look at it every once in a while, if you eat dessert every once in a while, that's probably okay, keeps you entertained and all that sort of stuff. But if you start doing it all the time and that's kind of all you consume, that can be really bad for your financial health as well as your personal health if you just all you eat is dessert, right? So that's kind of an analogy that I liked as well. And that's the second area where Charlie Munger and Warren Buffett think Ben Graham may have gone a little bit astray. Now, the third and final point that I just want to touch on briefly is probably something that doesn't apply so much to small investors like you and me, but it may well apply if you're going to, buy a small private business, or if you eventually grow yourself into a larger investor and can buy really substantial stakes in companies at some point down the road. So that final point I want to touch on is that Ben Graham never really talked to management, never really liked to even visit some of these companies that much. He did visit many companies, but certainly not all of them. He didn't often go to corporate headquarters and that sort of stuff and speak with the CEOs and the CFOs and so on. And the reason that he did that is sort of twofold. Now, the first reason is he did suspect that he could potentially be influenced by some of these people if he met them. And again, I've heard people like Pabrai and Guy Spear talk about this in the past, but both of those guys have changed their tune slightly on this and are much more open to talking to management now. But basically the theory was that, if someone's the CEO of a large company, often they're a very good salesperson, and they're probably in that position for that reason to a significant extent. So if you were to go and visit those people, they could potentially influence you in a way that wouldn't have otherwise happened if you were just reading the plain facts out of annual reports and so on. So that was the first reason. And the second reason, again, it's kind of interesting. When Ben Graham was first putting this sort of value investing philosophy together, he really wanted it to be something that everyday people could apply. He wanted to be able to teach it to his students and have his students and so on, even if they were managing very small amounts of money, be able to go out and practice this exact strategy. So, small investors who don't have the ability to buy really meaningful stakes in many of these companies really don't have the ability to talk to management. And that is the reason that Ben Graham didn't want to do it either. He didn't want to put himself in a potentially advantaged position over some of his students and then try and teach a method that they couldn't fully apply. And although Charlie Munger and Warren Buffett aren't talking to management in every single, investment in a public stock that they make, they certainly are from time to time. And of course, when they're buying into private businesses, you have to be talking to management to negotiate deals and all that sort of stuff. And they really want to be sure that they're working with great people and not potentially just hardcore salesy people that might not necessarily be presenting all, fully truthful information. So those are three of the mistakes or things that Buffett and Munger think that Ben Graham could have improved on. But nonetheless, Ben Graham was an absolute legend of value investing. He started the whole thing, and he came up with a few core concepts that worked in the 1920s and 30s and 40s that still work today and will still work 100 years from now, and that is incredible. Love to hear your thoughts on this down in the comments below if you would like to share. But that's all from me today, and I will see you in the next one. Cheers.